Good morning, patrons. Thank you for joining me this morning for another sentiment analysis. But before we get too much into the sentiment and the analysis, let's talk a little bit about last week. What you're looking at on the screen is my diagnostics system for Newshound. I'm showing this because the one event that has resonated within the United States hasn't really made the global news circuit yet. That may be good or bad, I don't know. But it really is indicative of what the JRSA report itself is about. In order to try to weed out the noise of the analysis, I try to focus on events that have a global impact, because that global emotional impact will translate into a global financial impact at some point. So as we progress through these reports, please understand that this isn't ignoring news. It's simply dealing with a global news of 250 different places from around the world. That being said, let's get into the nitty-gritty and start talking about some of the details of my own personal trading. Let's start with my real money account. It's a rather quiet month, as we can see, for my real money account. I've actually only made $3 worth. That's it, $3, nothing else. So the volatility of the live market for September so far has been abysmal at best. But that's fine, because that just shows the market frequencies. But if we go back a little bit and we look at the last several months, we can see overall, from the beginning of the year, we have quite a bit of good stuff here, and even a few stop losses along the way, which is fine. That's going to happen. You accept the stop losses the way they are. The smaller values are the reductions that take place automatically. This is what grid trading is about. It requires volatility. And sometimes if the volatility gets too high, you take losses. But those losses show up in the profits as well. So I made $58 for April in pure profits, but I took stop losses aggressively. So the volatility was good, but it was too much. And that's what caused the stop losses to trigger. The bot to do its thing and protect my account. But if we look at May, I had the right amount of volatility and the right amount of profitability. So I made out that month. And we can see over the course of even last year, where in November of last year, I had a very good month that was very volatile, but not too much volatility. Volatility is a very wonderful tool because it drives the markets. But there is too much of a good thing, and there is also not enough of a good thing. By tracking volatility over the course of several months in this kind of a situation, we can get a resonant pattern of the market. And we can see so far that 2025 has not been that great of a year. There have been a couple of good months coming down from the 2024 Christmas season. But then, given political market tensions, we can see how volatility has dropped quite drastically. So from the standpoint of my own personal trading, it's a slow and steady approach. But that slow and steady approach does have the consequence of a total net profit. It's not a lot, but this is a grid bot. It's not meant to be a lot. It's meant to be a proper amount. Now here I can see that my average profit per month is roughly $8.83 for this account. That's not bad. It's not wonderful. It's not going to make me rich, but it's still profit. And the overall total of my account is a profit of $194. Given that I only started out with a $1,000 budget for this account to begin with, that's a 19% profit overall. And that's after the reductions of $73. So I gave back $73 versus taking them in hard stop losses. The mitigation process of what was necessary to protect my account. Those stop losses, 35 of them, they hurt. They had an impact. There's no denying that impact. But by taking the losses on my terms as much as I could, I mitigated the full force of those stop losses. So far to date through this account, I've placed 3,085 real trades, and my average trade has been 6 cents of profit. Now this does work in the losses as well, which when you look back at my other videos, you'll see that OANDA shows a rough 30-cent profit per trade. But this factors in the losses. So with the losses, my actual profit is 6 cents. My average reduction is 2 cents per every single trade I make. That's not bad. That's actually very good. And we can see that my average monthly reduction rate is about $3. So that factors in a total picture that gives me a risk mitigation approach that protects my real money account. And right now in this market, that's hard to do. When you really look at what we are seeing in terms of actual trading volume, volatility, and liquidity, given the current market circumstances, I'm actually quite happy with the way this is going. I'm above where I started. I have a 19% profit roughly, given what I started with for my balance. That's better than 90% of all traders on the market by a long shot. So let's continue with examining some of these details from my own trading. Next, we're going to move to the Mimic account and talk about it. Okay, I've already posted this information this morning in the Discord VIP area for a live pull down, and this is the live latest of what I have for the Mimic wallet. 130 different assets. And understanding this table is important because you should not try to trade all of these assets at one time. Now the position size that I used on every single position is just a flat $10, so I can keep track of the math easily. If you wanted to go through compounding, you would use a 1% or a 0.5%, whatever you felt was comfortable for your risk management. But because of what I did for a flat rate, my current maximum number of open positions simultaneously is 2,486, or my actual real budget used so far as a maximum is 24,860. Now, if you apply the golden rule of rounding up to the next 10 and then multiplying by 2, this would be a $50,000 budget roughly. But the real way to use this information isn't to try to trade every one of these assets. It's to be better about your strategies, about how to actually apply them. So let's take a look at this chart in a different way after we explain some of the nuances. The first column here is the open positions. Throughout the course of this simulation, which started September 2nd, I have opened 4,200 274 trades. These are the actual orders that have been placed across 130 different assets. I have closed and profited from 3,712 trades. That's quite a bit. But the secret behind this is aggregation. That is the whole driving point behind all of this profitability. The profits themselves aren't that big, and they don't need to be when you're aggregating large amounts of them. My current open, the number of positions I have right now open, is 562. That means right now the amount of money on the table is $5,620 for this simulation. So that's quite a bit of money, but when you look at the exposure rate compared to the maximum of roughly $25,000 currently used, that's not bad. It's reasonable. Now we look at the amount of fees, the cost of trading. So far, this simulation would have incurred $212 rounded if it was real money. So that's not bad, really, compared to the amount of profit it has generated. And right now, my total exposure for this simulation is $5,020. The actual money on the table for all of these assets. $5,020. Not bad. It's reasonable, it's respectable, it allows a rough estimate of what you can expect in a real trading environment if you actually tried to do this on your own. And for the record, USD, USDT, and USDC had $10,000 each as a starting budget. So this simulation would require $30,000, roughly speaking. Now let's talk about the actual wallet profits and look at which one has done the most profiting. We can see by looking at this table that it is now sorted by the last column. This last column is the actual profit in the wallet. How much did the wallet actually make? Well, we can see right away by looking at MOG that it had 49 opens, 49 closes, and no actives. And it had a maximum of $180 on the table, 18 positions. So in terms of trading, in terms of taking this simulation to a real money account, this gives you a rough standpoint of what you could expect and a way to figure out what a reasonable budget would be for this account. Now, because this is a spot market, we don't have to worry about liquidations or decay rates or any of the other problems that are typically associated with cryptocurrency futures. But we can see clearly a very good representation of what to expect, including the fact that we paid $2.60 in fees, and we have a total profit after fees and everything else of roughly $13. So this is a reasonable mock-up. This gives us a clue in terms of how well we have done. But this information can be sorted in a myriad of ways. We can actually find out which coin did the worst as well. So let's see if we can find that one. Okay, I have resorted the table, and now we can see that the worst performing asset, or the one that has so far the highest number of trades, is Syrup. Right now, it has had 122 open trades. It has closed out 82 trades, but it currently has open 40 trades, and it's had a maximum of 80 trades. So for the standpoint of this asset, its maximum budget so far has been $800. It's not necessarily an asset I would personally want to trade with a live market, even though it's had only $5 in fees. Right now, I'm holding roughly $386 of syrup. That's not really looking good for this asset. But that's the whole point of this simulation, to show you what does work well and what might need different considerations. Now let's see what the worst coin of all has been so far. The worst coin of all so far has been syrup, but Sol has actually been the second worst coin. And the third worst coin has been Bitcoin Cash. So we can see on the market just how well this transcends into real world information that we can take into our sentiment analysis. We can see that the cryptocurrency market has a lot of winners, but those winners have consequences. And understanding how long we hold, how long we maintain that hold on an asset, gives us a way of looking at how well we can profit in an aggregated situation. Now let's take a look at that aggregation. Let's see just how much profit we have made since September 2nd on this simulated account. We are now looking at Oliver Twist's logs aggregated into totals. Oliver Twist is a part of the system that is maintaining the selling rate. It is handling when to sell at a 2% profit. We have the date, the account, the asset, and then the actual profitability we've made so far on just that asset. ADA USD so far has recorded $19 in profit. Bond USD has recorded $37 in profit. So we can clearly see how this translates into actions, and those actions are aggregated throughout the entire system. So let's go to the very bottom of this and get the totals. Okay, the totals are very clear. We have 1,112 trades. We've taken no stop losses because this is a spot account and I simply want to hold until opportunities. And we've taken $1,012 in profit. We've taken 3,712 trades. Tongue-tied there. So out of 3,700 trades, $1,012 of profit. Let's see. For most of these assets being USD and USDT, that's roughly $20,000. You're looking at about a 5% total return trade just on the majority. In other words, if you took out the USDC, you really wouldn't see much of a difference with the profitability of this account. So a $5 profit since September 2nd, or a 5% profit. So $1,112 out of roughly $20,000 as a crude estimate of real money potential. Now from that, we can see that the average trade is 29 cents. So every trade has an average profit of 29 cents. That's not bad. That's actually quite good. But the trick, the secret to all of this isn't large position sizes. The secret to all of this is aggregation. And this aggregation helps us actually see the best and worst performing trades. And like the other table, we can actually sort this appropriately. So now looking at this table sorted by profit with the best one being at the bottom. Node Euro made $44. Now this is in the euro, so it had a $10,000 budget associated with it. So if you wanted to trade euro, that gives you a rough basis of what to expect. It's not award-winning, but it's good. For the USD, we see that both bond and step really did outperform pretty much everything else. But overall, again, this is about aggregation, being able to take advantage of small positions over time. And those small positions add up nicely. Now let's see what our worst performing assets are. Okay, Mina and Milena, and LIT and ZRX. They are the worst ones, and really all of these under $1. I would consider not that great unless I had a prime interest in them for some reason. ZRX and Dash are a bit of a surprise in one way, as I would have thought they would have done better. KNC is also a bit of a surprise, considering this is Kraken, and that is, well, the Kraken coin. So I would have thought that would have done better. But we can see, though, how to actually evaluate the reality of what would and would not be profitable for our trading. But from here, let's get into the charts. Actually look at the real data, the real sentiment, and go from there. Looking at the actual Jackrabbit sentiment analysis, the human Forex stock crypto tables, we can see that for the most part, it's been reasonably consistent. There's been some back and forth between fear and greed, but for the last week and a half, we've been more on the fear side, and the strength has been reasonably consistent. In other words, people not interested in taking on a lot of unnecessary debt or big purchases as a generality. Also, given the current news events, everything factored together. But this isn't really the big part. The big part that we need to really focus on is right here. This obscene back and forth rapid shift. This is important because it shows a very clear market turbulence. And this is considering every aspect of the market for this turbulence. This is volatility in a very dangerous way, a damaging way. When consumer sentiment, buyer sentiment, shifts and rotates with extremes, it often leads to severe market turmoil. And that can cause unusual or unexpected panic selling in the market, depending upon what industry is actually correlating to this change. So as you look at your own investments, as you look at what you are actually trading, this kind of information is pure gold because you can see exactly what the market is doing from the media standpoint, from the Forex standpoint of global currencies, from the stock standpoint of all of the major indexes, and even from the Wild West standpoint of the cryptocurrency market. We have a real world litmus test on how to protect our finances and what to expect out of the market. Information like this correlates to risk management. And when this type of a situation does play out, it means that we need to be more cautious about our expenditures. So let's move on to the next chart. The Forex chart is interesting, and it really is a telltale sign of an unusual situation within the currency markets themselves, particularly with the last article I published regarding Canada's housing crisis and the bigger picture of Canada's own economic situations. The Forex market shows how the global currencies are interplaying and interacting to all of this big news. The nuance here isn't so much the fear and the greed being exhibited, even though that is important information for large position sizes, is not the story. The story really is the strength of the movement. And we can see that for the most part, even with everything that has gone on this past week, the Forex market hasn't moved very much. Unlike around August 2nd, where it actually had a substantial move compared to other market days. So we can clearly see from the daily level that the Forex market is reasonably stable. But let's take a look at the bigger picture. Let's look at the weekly. Now looking at the weekly chart for the Forex, we can clearly see that there is oscillation in consumer and country sentiment. But it's still not that significant. And that's the real story. The actual movement in the market isn't that graphic. Whereas if we look again around August 2nd, we can clearly see that whatever happened on this date had more of an impact on the market. So we have a way to correlate time to event, and we can begin to actually see and track what really matters in the market. Whether it is the Bank of Canada talking about raising interest rates or things of that matter that do have a larger economic presence within the Forex market. Moving on to the stock market, the global indexes. We can see that we've had a few significant events that have led to major movements within the market. We can see those events have a point of view, and we can see how they actually factor in the fear and greed ratios. That being said, this again we can correlate to news events, company holdings, things that matter in the index market itself, and how that plays out with people having money in their 401ks or other particular kinds of assets that might bring in dividends and revenue on a consistent basis. We can also see from looking at the market, for example, back around the end of July versus what we see now. We see the volatility play out between the shift of fear and greed. So not only do we have high strength moments, we have large numbers of pushes that aren't necessarily indicative of a normal market structure. And we can actually check that to see if that plays out true on a wider time frame like the weekly. Now looking at the weekly, we actually see a different story versus the more localized daily. The weekly shows the averages, but we still see some important details. We see that back around July, the market didn't have much activity. It was reasonably flat. But then we see that it started reacting and beginning to bow and bow on a rather significant basis. That is the indexes. The Russell 3000, Russell 1000, S&P 500, Dow Jones, Nike, they all started to pay attention to something. And that something translated into a significant greed event around the beginning part of September. So we can see a huge strength push compared to the rest of September and prior, where something here triggered a huge consumer sentiment rush. Now that could be the upcoming holiday season, or that could be bank rates or any other market-based system that realistically has allowed the market to have this kind of a strength. But by paying attention to these metrics, by understanding the correlation between these metrics and real news events, we can get an idea of the driving forces that help us profit. Moving on. Finally, we reached the cryptocurrency market, the wild west of trading. But it isn't as wild as people like to make it out to believe. We can see that the fear and the greed oscillates quite aggressively, but it is consistent in that oscillation. In other words, it reacts to whatever happens to blow in the wind. But that reaction isn't as pronounced as the media makes it out to be. Really, there are only two significant points where the market movement really went to an extreme. We have a few other areas that should probably be considered, but overall we can see very clear correlations. And again, we can correlate this directly to whatever news events are going on within the industry on these days. But for the most part, the part that really stands out is that most of the market really doesn't have a big sentiment push one way or the other. It remains reasonably neutral for a lot of areas. Most of the market simply is a come as it is approach. Outside the 4 points I demonstrated, I would say that the market is probably within a reasonable expectation of standard deviation given the 1,300 assets that get looked at to build this chart. But the overall premise, the overall value of this information is understanding that we are looking at aggregation in a larger macro event. Aggregation that provides us with a way to make informed decisions. Now let's look at this market on the 7-day and see what it has to say there. Okay, now looking at the 7-day market, we can really see that there's really only one significant event around August 24th for the crypto market. But the strength itself, even though there are a few places of interest, the market itself didn't really become extreme. No huge levels of unexpected volatility. And that really is the whole point. If we correlate the August 24th with the actual sentiment, even though it lasted a significant amount of time, the actual market sentiment really didn't show a huge significant push. For the cryptocurrency market, a push of 5% would be a significant push. A push of 0.5%, that's barely noticeable in most people's cryptocurrency wallets. A push of 1% might get attention, but maybe not, particularly if there's not a lot of strength correlated to that 1% push. The nuance here is understanding how strength applies to the actual fear-greed oscillation, and then taking that information into your own trading. This isn't about getting rich quick. It's about looking at the market in a way that produces consistency. So at this point, We have a lot to talk about in terms of what we think might happen next week. I think Canada is going to continue on its current course. And I think its self-sabotaging tariffs are going to continue to have their impact. I think the cryptocurrency market is going to do very well overall as long as you have a worst case plan in place, as long as you can openly see where you're going and what the end game is. The goal here isn't to hold on forever, because that's going to get you nowhere. The goal here is to be strategic about what you hold. Pick and choose the assets that fit best with your risk assessment, provide a high volatility level, and provide a high liquidity level. All of the winners that I demonstrated through Oliver Twist, they all had those combinations. They had high liquidity, they had high trading, and they had high profits. Holding them for the duration, though, is one of the more major problems that needs to be focused on if you are looking for your long-term stability. Not every cryptocurrency asset is equal, and some assets don't do well. Looking at the wallet, looking at your transactions, taking into account your fees, all of that is part of a long-term process. And for the standpoint of being successful next week, having that information is worth more than gold. The best approach for next week, I believe, is cautious. I'm not going to say that the Canadian market's going to outright collapse, because I don't think that's accurate. Just like it's not accurate to say that the US market is just going to outright collapse, or the European market. I think we could see and attribute certain economic stresses to certain decisions. But the worst decisions that any country is going to face isn't from the outside. It's from their own governments. And I think in Canada's case, in the case of the United States, in the case of the European Union, I think that is going to be the biggest deciding factor. Whether or not the government straightens itself out or it keeps spiraling out of control. As we look for the bigger markets, volatility is definitely not the greatest this month. I don't know if that's people pulling out for the Christmas holiday and all of the accoutrements that go along with that holiday, or just the overall sentiment that people don't like where their economy is going. But it's worth paying attention to. It's worth not taking a chance on some of the weaker, lesser known assets. Share your thoughts though and let me know what you think. How has your trading been this week? Have you done well? Have you taken any stop losses or hits? Let me know. Thank you again for watching, and most importantly, thank you for your support and patronage. A lot of this research can't be done without you, and that really means a lot to me. Thank you.